From New York City, for our viewers worldwide, I'm Manus Cranny, in for Jonathan Ferro. Equity markets this morning managed to claw back some of the losses in the latter part of last week. Alphabet is bid on that beautiful new relationship of growth between Apple and Alphabet. Countdown to the Open kicks in right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Coming up on the show, investors brace for a busy week of global rate decisions. AI in focus with Nvidia's developer conference getting underway. And Apple turning to Google in its search for AI solutions. We begin with the big issue, counting down to the Fed.
When I look at the growth of the economy, I look at the labor market still being relatively healthy, and I look at the inflation not getting to the terminal rate of 2%. I don't see the cut motivation. I think that's the problem that I'm wrestling with is what is the Fed policy cover, if you will, to be cutting rates when what they're doing seems to be working and yet not quite to mission accomplished.
Well, Bloomberg's Mike McKee joins us now to set the table for the week. Mike, good to see you. It's all about the dots. Or not.
It is all about the dots, Manus. The Fed has pretty much signaled they're not going to do anything with interest rates. So what else do we get? Dot plots and the summary of economic projections. The dot plot is the one to watch. That's where Wall Street's eyes will be. If you take a look there at the red line, that is the OIS, the overnight index swaps view of where rates should be. And as you can see, it's just a little bit below the median dots in 2024. So there is a feeling that maybe we'll see some movement away from 3 cuts to just 2. It would take 2 members to move their dots, but at this point, we don't know. But if there is a change, it'll show up there. Don't worry about 225, 226, because those are so far out. There's so much going on that any change there would be essentially meaningless. But the 2024 dots are going to get a lot of attention. Also, the summary of economic projections, because that, in theory, underpins the dot plot. As you can see, the Fed's December numbers are a little bit behind what economists surveyed by Bloomberg last week came up with, especially for inflation. So will the Fed move their inflation targets higher as a justification for changing their dots? Do they see a stronger economy? Remember, Raphael Bostic said that is a risk out there for the economy. So those are the 2 things we're going to be watching on Wednesday. Also, Jay Powell obviously has his news conference.
He has indeed. I wonder which is going to be more important, Jay Powell's news conference or Jensen Huang's conference later today on AI. Listen, talk to me about what the future might look like in a changed political landscape. We've got the Wall Street Journal reporting that Donald Trump has been presented with 3 names as the possible replacements for Jay Powell if he becomes president and if there was an interruption in Powell's term, or maybe even after.
Well, it looks like this is somebody running something up a flagpole and seeing if Donald Trump is interested in saluting. It was a group of 3 names. You know them all: Kevin Warsh, Kevin Hassett, and Arthur Laffer of the Laffer curve fame. They were put together by people who are not officially part of any kind of transition team. It's just a group of people that Stephen Moore and Art Laffer, funny how that works, are promoting. Warsh was a member of the Fed, and so he could be a serious candidate. Hassett was chairman of the Council of Economic Advisors. Laffer's interesting, especially since he's putting his own name forward. He would be 85 at the time that there is an opening on the Fed, and he is against tariffs. So I'm not sure that one totally fits with Donald Trump, but I wouldn't pay a whole lot of attention to this. The current chairman's term runs until January of 2026. So it's going to be quite some time before anybody is going to be named to replace him one way or the other.
Okay, Mike, interesting kite flying by the Journal. Mike McKee there on the week ahead. Let's start the conversation with BlackRock's Amanda Lynam and Tallbacken's Michael Purves joining me here in the studio. Michael, to you first of all. It's been a while since we've had a human in the studio, so welcome. Good to see you, Amanda. Good to see you as well. The acknowledgement could be that the disinflation narrative is slowing down, and therefore there is merit in cutting the dots, the median dots from 3 to 2. It wouldn't take much to do it. Do you think that that would be good, prudent governance to shove the market down to 50 basis points?
Look, I think it's an irony that crude bottomed in this, over the last 6 months. It bottomed on the same day that the Fed's December FOMC occurred, when they really delivered that dovish surprise here. And since that dovish surprise, we've seen a wide range of inflation data come in hotter than expected. We've seen a wide range of economic data, exhibit continued persistence and be hotter than expected here. So I think what the Fed seems to be signaling from December is that it was a pivot from hiking to something that's either static or cuts if warranted. And so what warrants the cuts? I think it's going to be, I don't think Powell's going to shoot until he sees the white of real disinflation eyes here. And the reality is we've seen so many facets of inflation, the reported inflation that we got last week, continuing to trend away from the Fed's 2% target. If you look at the monthly sequential prints across a wide range of the subcomponents there. So I think the Fed's going to signal on Wednesday, we'll cut when warranted, but right now it's not warranted.
So they want to see the whites of the eyes of the disinflation returning again. Amanda, good morning. Good to have you with me. Kicking off a big central bank week, but let's focus in on the Fed first of all. This disinflation narrative has been interrupted, or the trajectory of it. We expect the estimates for core and headline inflation to be raised again. Are you positioning for a jolt in terms of this market? We can debate where rates get to, but the rates market has backed up considerably. Would a 3 to 2 shift in the dots be a material shock to risk and to this market this week, or is it already imbued?
Good morning, Manus. Thank you for having me. I think as it relates to the dots and the summary of economic projections, I think stability would be good for market sentiment. So I think downgrading that to only 2 cuts versus the current 3, I think would send a bit of a shock to the market. It feels to me, based on our conversations, that that's on folks' radar as a risk, but not necessarily the base case. I think from our perspective, there were 3 really important things heading into this meeting on Wednesday. One is an acknowledgement that we are at peak rates. So ideally that there's a very low likelihood of additional hikes. The second would be that rate cuts are coming eventually in 2024. Our base case remains the second half of 2024, with risk skewed earlier within that second half range. That's a wide range. I think it's hard to have any precision beyond that. But just the fact that rates would eventually be coming in 2024 is, I think, what the market is going to listen for. We can debate about where the terminal rate is later. And then third is really important, that the reason for any future rate cuts, or the rate cuts that the market is expecting, is really driven by improved inflation eventually, as opposed to a downturn in growth. If we have those 3 things, we think that's a pretty supportive backdrop for risk assets. And I think the direction and the path of least resistance in my market, at least for corporate credit spreads, would be tighter on that, especially as the headwind from corporate credit supply is waning as we head into the blackout period around earnings.
Okay, and we'll come back to those spreads because they are mighty tight, and you've identified that in IG and in high yield. 92 basis points on IG, but we'll come back to that in a moment. Michael, I want to pick up, I mean, Amanda is giving herself, and I think the market perspective, the breadth that we need in terms of the Fed needs more concrete confidence to actually start this cycle, because once they pull the trigger, the market is then going to expect a cycle to ensue. You would say a barrier to that cycle starting is super core, and you identify this and you talk about, and this is where I want to talk about the possibility of stagflation. Now, this is what you identify as being the super core. We're on a trajectory now. It's the highest since June 2022, and this is looking at it over a period of time. Does this cause you hesitation? Should this cause the bond market more hesitation than it is currently showing?
Look, I've been on this page for, well, actually, I think I originally presented 18 months ago that when the Fed got to its terminal, that it should camp out there for a very long period of time because of some structural inflationary forces that are creeping through at a slow and kind of somewhat convoluted pace, but they're persisting, and that A lot of it comes down to various supply, whether you can talk about labor, you could talk about shelter, and also even commodities, as we're starting to see. There's a big supply dimension to all those things that really doesn't have anything to do with COVID, but they are slower moving forces there. So my view here, look, I've been officially at the 1 to 2 cuts this year, but I think there's a real scenario of 0 cuts. That seems to be an increasing scenario, a chance of a scenario here.
So briefly, if it was 0, if it did skew to 2 and then to 0 cuts, a real probability, what would that do to the rates market?
Well, I think investors have to be prepared for a 10-year. They have to be able to visualize how do risk assets trade with a 4.5% 10-year, then maybe a 5% 10-year. Right now, obviously, last October, things got a little, you saw the VIX spike and all that with that move here. I would suspect that you're going, if rates do continue to drift higher, it's not going to be nearly as violent. You did see the MOVE index, the VIX for the Treasury curve, come down to sort of cycle lows on last week, even with a rate move higher here. And I think that's largely because this is more about what I would call tweaking. I think we're in a tweaking cycle from the Fed as they're adjusting it, as opposed to the violent inflation that we had in 22, which unleashed a violent hiking cycle.
Yeah, and I think we are that. Amanda, we're getting these moments of irritation, but I want to revert back to where you said, you talked about investment grade and high yield, those spreads being tight. If there's a risk, as Michael says, and it's not a 0 risk of no rate cuts, maybe 2 rate cuts indicated, maybe even shaving that down, would that shake risk in your markets by any magnitude? And I'm talking about IG and high yield. That's what we're showing at the moment on the screen.
Yeah, sure. It depends on the reason. And I think Michael's exactly right. The velocity of getting to that kind of higher rate level is important. But under the surface, to answer your question, Manus, if we're going to two cuts priced or no cuts priced in 2024 because growth is so resilient, credit would like that outcome, so long as that velocity in getting to that higher rate move is not extreme. But if it is because of persistent inflation and a resurgence of stagflation concerns, that is typically not a backdrop that corporate credit likes. To the point on spreads, they do look optically tight, but I think it's important to note that we're actually still wide to the mid-2021 levels. So there is some scope for further tightening, again, so long as that growth backdrop remains supportive. I think the key outcome for allocation tactically, from an asset allocation perspective, is we're seeing more interest in clients kind of putting on floating rate exposures. That could be in liquid credit, in private credit. And so giving some additional diversification to the portfolio if these rate cuts do get priced out to a further extent, I think is probably a smart move tactically, and that's something that we are having come up more and more in our conversations.
All hail the RFNs. Amanda, stay with us. Amanda Lynam and Michael Purves, my guests this morning, setting the tone on a big week for central banks around the world. Let's take a look at the stocks ahead of the opening bell. Abigail Doolittle is with me side by side.
Manus, we do have U.S. equity futures very firm, and this has a lot to do with the Mag 7, starting off with the shares of Alphabet. They are headed to the best day of the year if the gains hold. This as Apple is holding talks with Alphabet to let Google's Gemini power its iPhone features. This could be a blockbuster agreement and shake up the AI industry, some are saying. Nvidia up 2.7%. Their AI event kicks off in San Jose today. It's been dubbed the Woodstock AI by Bank of America analysts. More than 300,000 people are expected to attend. And then Tesla up 4.1%. Popping on reports they may raise prices instead of lowering them. That's been the report over quite some time now, but on the Model Y this April, Manus.
There you go, Woodstock of AI. Who'd have thought it? Abigail, thank you very much. Context for that developers conference later on this afternoon. Coming up on the show, the BOJ kicks off a busy week of rate decisions.
The Bank of Japan, clearly is on the path to normalizing, and whether it's this meeting or next, it's almost going to happen.
From the BOJ to the Bank of England, the Fed isn't the only game in town. That conversation next on Bloomberg.
The Bank of Japan, clearly is on the path to normalizing, and whether it's this meeting or next, it's almost going to happen. Having said that, if they move, we'd expect them to move, but also at the same time talk expectations down, so they don't want to have a runaway policy expectations of higher and higher rates. They'd want to push back against that.
A monumental moment for Japan. Is the central bank widely expected to hike rates for the first time in 17 years? The BOJ is part of a busy week of central bankers globally. Monetary decisions will be made in nearly half of the world, including the 6 out of the top 10 most traded currencies. Rev up your FX vol. Enda Curran is with me now. Top of that agenda is going to be Bank of Japan. Enda, good day to you. Set the table for me. Good morning.
Well, there are over 20 central banks decisions this week, Manus, and like you say, the BOJ meeting will probably be the most closely watched BOJ decision in years, if not longer. We had, of course, the all-important union wage round results that came out at the end of last week, showing that wage gains are probably going to be much higher than expected. A lot of economists saying that's the final green light now for the Bank of Japan to go ahead and pull out of that negative rate territory. The question becomes then, does it push further into positive territory? Does it tweak its other policy tools? Now, there is still a camp out there that's saying perhaps the BOJ might wait until April, but by all accounts, one of the last remaining hurdles for that hike has now been cleared. Beyond Japan, also it's worth noting that Australia is meeting this week. Inflation slowing there, so clearing the way perhaps for the central bank to suggest they can move towards a rate cut at some point this year. Bank of England also meeting. No major change in their outlook or signal expected there. They will have inflation data before they meet, but a bigger change is expected to become in May. But net this week is expected to show that all of these central banks are moving in an asynchronous pace. They're all dealing with idiosyncratic issues impacting their own economies in different ways to everyone else.
Indeed, and everybody with one eye on the Fed and what their messaging is going to be, because that gives them all a certain amount of guidance. Enda, thank you very much. Enda Curran with the very latest on what's going to be a big week for global central banks. My guests this morning are Amanda Lynam and Michael Purves. Amanda, to you first of all. I look at this as a historical moment. To me, the Bank of Japan moving, yet yen is not reacting in the typical way that we would expect it to do, scrapping of negative rates, etc. Quantify that for me in terms of the flow dynamics for fixed income here in the US as a result of a global event.
Sure. So roughly 1/4 of the U.S. corporate credit market is owned by foreign investors. You can see that clearly in the Federal Reserve flow of funds data. So foreign participation in U.S. dollar credit is meaningful, and for much of the post-financial crisis period in particular, Japanese investors have been net buyers of credit alongside foreign investors more broadly. The normalization and I would say the beginning of what might be a hiking cycle from the Bank of Japan has caused investors to ask whether that participation appetite for U.S. dollar corporate credit could shift. We think that's really a high bar and a longer-term issue, even though it is symbolic, as you mentioned, Manus, the fact that we would be moving out of negative rates in Japan. The tweaks are expected to be minor, and the differential between the policy rates and the rates in Japan is still pretty wide. Yeah. That being said, it's something to watch, and certainly we will be doing that. The other thing I would add is that when you think about foreign participation in U.S. dollar credit, it's not only driven by economic factors on paper like hedging costs and yield differentials. It's also driven by sometimes a lack of alternatives in these domestic markets. And so, as you well know, the U.S. corporate credit market has significant depth and breadth. And in a lot of instances, including in the case of Japan, there just isn't a robust corporate credit market for those investors to participate in. So they often look to the U.S. dollar market. That is a structural shift, and that we don't expect to change on the back of any monetary policy shifts.
Thank goodness for some markets, TINA still exists, even when it comes to the credit markets. Amanda, stay there. Michael, I mean, maybe it'll mean more for the foreign exchange market than it will for credit markets. Is that, I mean, so far it hasn't had the reaction function that we would have presumed. So talk me through why.
Well, I think I agree with you. I think it is a historic event, what's going to be happening with
if it happens. If it happens, I should count that.
But what's important for the U.S. markets, I would suggest, Manny, is that one of the questions hanging over the Fed is, are we normalizing to pre-COVID, meaning 2017, 18, 19, or are we maybe normalizing, as I think we are, to something before the great financial crisis, before the QE era? And with the Bank of Japan really sort of being the last to really get out of negative interest rates, I think it's a gesture that the collective mindset of these big central banks is going to be away from this ultra dovish policy and to normalize to something that we didn't know that was very customary before the financial crisis. That's very significant. And I think one thing to watch is just the 10-year term premium on U.S. Treasuries, whether that really helps lift it up into positive territory on a sustained basis. And I think there's a good chance it will.
For you, Amanda, obviously term premium is going to be important, but I want to just close off with a snapshot on flow. We've had a heck of a start to the year here in the United States of America on the corporate front. Does that issuance continue unabated?
I think we'll get a temporary reprieve around earnings, as we typically do when corporates enter their quarter-end blackouts. You're right, the fund flow dynamics into corporate credit have been exceptionally strong to start the year. I would say that even understates demand a bit because that doesn't capture the entire universe of buyers. We talked initially, what would spreads do if rates backed up a bit? Yeah. There's a large cohort of yield-based buyers that would actually welcome deploying capital at even higher all-in yields. Again, presuming that backup in yields wasn't disorderly. So I think that the demand should remain robust for U.S. corporate credit. The reprieve that we will get from corporate supply will likely be a bit of a technical support mechanism in the next few weeks, I would say, until we get past the next earnings season. But it'll probably look to pick up as I think corporates will opportunistically take advantage of the strong tone to refinance upcoming maturities and really make sure their capital structures are in order.
Amanda, great to have you with us. And context there, yeah, back up in yield. A lot of deployers will be licking their lips. Amanda Lynam there, Michael Purves. My guest this morning setting the stage for a big week in central banks. Coming up on the show, your morning calls, and it is a monster week for big tech. The conversation's still ahead with LPL Financial's Quincy Krosby joins me for the Woodstock of AI preview. That is the Nvidia gathering today. Let's get you some of your morning calls from Wall Street. First up, HSBC raises Nvidia's price target to $1,050, highlighting the company's pricing power and the best-in-class AI pipeline. Next up, Williams downgrades Nike to a sell. That's ahead of the earnings, expecting the results to reveal weakening sales growth and also pressure on the margins. Finally, Morgan Stanley upgrades PepsiCo to overweight, pointing to a compelling valuation and an underappreciated global strength and reach. Coming up, Quincy Krosby joins me as we head into this opening bell on why stocks could be set for a pullback. That's a conversation you maybe want to tune into in the next couple of minutes. No sign of it at the moment. Counting down to the open in the next couple of seconds. We have a tech tinge this morning, helping us claw back some of the losses in the latter part of last week. You've got Alphabet going bid on the back of a potential deal with Apple to go into the iPhones. Will that go through at a regulatory level? Nvidia is the Woodstock of AI today. Had to be a boomer that wrote that. Somebody just sent that in on the ticker to me. There you go. They're happy at the nicey this morning, 52.25. I mean, is there any smell of a pullback at all? What happens if these rates do go above 432? According to Mike Wilson over at Morgan Stanley, that is an inflection point at which equities would need to reflect more carefully. There are your yields this morning, up a pip at 432. Mike Wilson makes the point this is a moment of inflection of where equity, the power of the equity rally may well be challenged by those slightly higher rates, up 24 basis points last week. Crude is up 0.7%. We just had Michael Purves with us talking about the rally in crude since the Powell pivot. It is a headwind in the inflation story. Dollar yen, it's going to be a big day. They say tomorrow could be the Bank of Japan exits its negative rates. The yen continues to decline, and the dollar has been for the 5th day in a row. So FX is not giving you the classic reaction. I mentioned one stock at the start. Of course, it is Alphabet and Apple. That tech giant is in talks to build Google's Gemini AI engine into the iPhone. That's according to Bloomberg reporting. Abigail Doolittle is with me on the details. Could be a big old move for Apple and for Alphabet.
A big move for both of these companies, a continuation of other partnerships they have, or I would say a new growth of a new partnership for these two companies. But these stocks, investors really liking it. Apple having its best day since the middle of January. Google, Alphabet having its best day since July of last year. So the deal that you're talking about, and of course was a Bloomberg exclusive, Apple is in talks to build Google's Gemini AI engine into its iPhone. Sources are saying that these two companies are in active negotiations to let Apple license Gemini to power some of the new features coming to its iPhone, the operating system, this year. Now, Apple has also apparently had discussions with OpenAI and has considered using its model. Apple CEO Tim Cook has promised a big AI announcement this year. Now, if a deal between Apple and Alphabet comes to fruition, it would really build upon, I was mentioning another partnership, the two companies' search partnership. Alphabet pays Apple billions of dollars each year to make its search engine the default option within Safari on its iPhone and other applications. Now, these talks could suggest that Apple's AI efforts are a little bit behind the curve. And while this potential deal would give Gemini a big edge with billions of users, one thing seems clear, Manus, it could really shake up the AI landscape.
Yep, it sure could. Abby, thank you very much. Let's turn our attention to the other part of this analysis. It's the chips. Nvidia's GPU technology conference kicks off today in San Jose. Some are calling it the AI of Woodstock. Alex Webb is with me. I've had various IBs on this, is that the only person that could have dubbed it that was a boomer. So that's an irony for one of the biggest advances in our lifetime. So what are we going to get today? Is Jensen Huang's speech as equivalent to Powell is on macro policy?
I'm not sure I'd be quite that generous about it. Look, clearly 2 years ago, people wouldn't have even blinked at this conference, the vast majority. Even a year ago, I'm not sure it would have garnered quite this much attention. But of course, we've seen over the past 12 months the extent to which Nvidia has driven or contributed to the rally, but also how important its technology is to underpin so much of the innovation that we're seeing in artificial intelligence right now. Of course, the chips that have been doing that so far over the past 12 months or so are the B100. What we're expecting to see today is the H100, the next generation powering this. And not only is that important when it comes to the innovation piece, it's predicted to be as much as twice as efficient as the existing model lineup, but also when we look at the stock itself. Expectations are, of course, very high. It's trading, I think, something like 35 times its forward earnings, at least it was before today's open. In order to maintain and justify that pricing in the years ahead, it clearly needs to keep innovating in order to keep its what is right now market-leading position. There are lots of other companies, trying to clutch at its tail. As long as Nvidia continues to extend its lead, that's going to be ever harder to do.
Okay, let's see what there is later on in the day to get our teeth into. Alex, thank you very much. Let's stick with tech. Tesla's jumping. The news is that the company, get this, that they're going to raise the price of their Model Y cars in April. Simone Foxman. So this is a bit of a shift in gears, excuse the pun. We're normally reporting price cuts, Simone. What do we think we're going to get?
Yeah, well, we're going to get, according to the company, which tweeted this late Friday night, a $1,000 increase to the price of the Model Y vehicles starting April 1st. Model Y, you may recall, is the midsize SUV. And this is a car that starts at just shy of $44,000 before tax breaks. I think we have to try and ask ourselves, though, why are we seeing this movement on prices? Is this a sign of demand? Is this a sign that the consumer can stomach higher prices? Well, the initial analyst reaction is no. In fact, Deutsche Bank and Evercore ISI both saying that this is likely a marketing push to try and sell more vehicles before the end of the first quarter, which ends at the end of March, because both of them say first quarter deliveries appear week. You may remember that Wells Fargo last week predicting zero growth for Tesla in sales this year and actual volume declines next year. So simply trying to get the cars off the lots right now. Also, I should note, just in the last couple of minutes, last hour or so, we saw the publication of a Don Lemon interview with Elon Musk, who said his prescribed use of ketamine, which alleviates periods of low mood for him, is in the best interest of investors in Tesla, as well as the other company he runs. This follows, of course, concerns about his recreational drug use, according to various reports, that not impacting Tesla shares at the moment as much as the news of these price hikes, which so far today has been a positive, Manus.
Okay, Simone, stock is nicely bid, up 2.3%. Simone Foxman there on the Tesla ladies. Let's turn to another story now. They've got a high-profile split. FedEx and Amazon, they've explored doing more business with each other. That's according to the Journal, the Wall Street Journal. Katie Geifeld is with me on this story. What have we got here?
Yeah, an interesting story out of the Wall Street Journal reporting that last year, the two companies, they had discussed FedEx accepting returns of Amazon packages at their retail locations. This, of course, was according to people familiar with the matter. And while Amazon has a partnership with many companies, including with UPS, for example, the FedEx and Amazon talks, they ultimately didn't reach a deal. Now, remember, FedEx had a partnership with Amazon years ago, but in 2019, FedEx ended delivery contracts to move Amazon packages, and that was, of course, as Amazon's competitive threat grew and has only grown since. And it appears that these talks restarted last year as FedEx really seeks to boost parcel volumes, and that will be the storyline to follow this week. When FedEx reports earnings, analysts expect that revenue will shrink for a sixth straight quarter. That is before a potential pickup next quarter. Those earnings hit on Thursday afternoon, Manus, so stay tuned.
Okay, well, eyes down for that. It's going to be a busy week from the macro to the micro. Now, StoneX, I should say, are discussing the craziness of the stock market at the moment. This is what they've got to say. It's like being high on drugs. The markets take the best of the AI story, the best of the disinflation story, the best of the growth story, and project that forever. Quincy Krosby is my guest this morning from LPL Financial, joining me now. Is that where we are? Are we in this forward projection mania, Quincy, or could the bond backup interrupt our enthusiasm? Good morning.
Good morning. Yeah, no, absolutely. You know, there's the yield line in the sand for the equity market, and we've been looking at, say, 4.3 on the 10-year. The market so far has been almost immune to the inching higher of the yields. But at some point, we may be getting closer to that the market is going to have to pull back and actually do something that we've been waiting for, and that is consolidate. The market's been overbought. We need a consolidation. Overbought markets can keep going, but something typically comes along to just let them start pulling back and digesting those gains. It could be from the Fed, the commentary. If they don't assuage market fears that there could be absolutely no rate cuts this year, we could actually see the yield climb higher, the equity market pull back. But you know what? Getting back to Nvidia, they came in their last earnings when we thought we were going to have a nice consolidation and gave the market a major reason to go higher when they announced the earnings and the CEO's famous quote, "We are at the tipping point for AI." They could do it again this week at 4 o'clock Eastern with the CEO's commentary, which is supposed to last a bit, or if we hear the term name Blackwell coming in, because that's supposedly the new name, the successor to Hopper. But the point is, at some point, the market really needs to just come back, adjust, recalibrate, and the Fed may give them that, and maybe they will be again helped by Nvidia.
Do you think, Quincy, that really, if there is an adjustment in the dots, it's only going to take two Fed members to move their dots to shift the narrative and the dialogue of what we're all going to talk about, which is perhaps shifting to 2 rate cuts, the median outlook to 2 rate cuts. That in of itself is probably not going to be enough to shake stocks.
No, it won't be. But what we're also seeing is that some of the dubs have actually moved in the camp of perhaps maybe 1 little rate cut and then we pause. That would be Bostic of the Atlanta Fed. But the point is the market has been underpinned by a notion that the Fed will keep going and cutting rates. Something has to take its place. And that will come from the earnings season, and we have a bit to go. Something has to take the place of those rate cuts. The valuations are so high now for the market that you need lower rates to underpin that higher valuation. And that's the issue overall for the market. The market will find its equilibrium. It always does. The question is not if, but when.
The concern is that at some juncture, the savings rate comes to bite the consumer in the United States of America. That savings rate has been dropping. Unemployment remains sub 4%. Wages are rising. So the third leg of that stool is the ability to spend. And if that savings rate is beginning to dissipate, is that something which only kicks in, that's got a longer lead time before it challenges the robustness of the consumer?
Well, absolutely. But, you know, when we look at the spending, most of it is coming from upper wage earners and those who feel safe with their jobs. One of the things we are seeing is that the companies are increasingly looking at the white collar workers. We see it in tech. We see it in the financial services. If that spreads across the broader spectrum for corporate America, you are going to see consumer spending come down. All you need to see is a higher unemployment rate where it's coming from. No one feels sorry for tech workers or those being let go from Wall Street. But if it hits the broader spectrum of names that the Americans know, where they're cutting workers, they will pull back spending. It invariably, every historical pattern indicates that, but we're not there yet. Spending continues. It is the higher wage earner that continues, but the higher wage earner is under the microscope from corporate America right now.
There's a couple of major tech stories which we're focusing on this morning. We're going to spend some time on Apple and Alphabet, perhaps commingling the AI functionality of Gemini from Alphabet into the next iteration of the iPhone. We've got, as you said, the AI, the Woodstock of AI a little bit later on today with Nvidia. When you look at the narrative to try and broaden your reach beyond the Magnificent Seven, how important is it for Apple to get a deal that changes the narrative around their AI proposition?
Apple has to do something. They know it. They're losing market share in China. That is going to continue. They have been almost deemed a value stock at this point. But one thing Apple does is they make money. They've got cash. They could come in and make an announcement of a major share buyback in conjunction with a new move towards AI. I think the Gemini deal is just one of many. They're not going to sit back and be relegated to a value stock. They understand that the market is waiting, and they will. I mean, the shutdown of the vehicle, the move towards a vehicle, was incredibly important. But they are shifting. They have been letting people go in other parts of the company to move more folks into AI. They just bought a company in Canada that is completely focused on AI. Mm-hmm. This is not going to deter Apple. They know that this is important, and investors are prepared to go into Nvidia, go into all of the companies that Nvidia basically underpins. They have a broad ecosystem of companies that once they shed light on another company, those share prices go up. Okay. And Nvidia will be buying more companies. Apple has to do something. They know it, and they probably will.
Go big, go bold, or go home. That's what they used to say at work. Quincy, thank you very much. Quincy Krosby.
Thank you.
Thank you so much for being with me this morning. Coming up, as Quincy has just been talking about, investors are bracing for the AI of Woodstock.
Look, we believe it's a 1995 moment. This AI revolution, this party, it's getting the popcorn out. It's 10 p.m. in a party that goes till 4:30 a.m.
That'd be a big party. We'll look ahead to that Nvidia AI conference today on Bloomberg.
Look, look, we believe it's a 1995 moment. This AI revolution, this party, it's getting the popcorn out. It's 10 p.m. in a party that goes till 4:30 a.m. This is now starting for the software sector, that AI momentum. This tech bull market continues to, I believe, go higher because of numbers, but it's going to be software-led.
The AI industry facing a possible shakeup. Bloomberg learned that Apple is in talks to build Google's artificial intelligence engine, Gemini, into the iPhone, setting the stage for a blockbuster agreement. Meanwhile, you've got Nvidia facing its latest test as the company's AI conference kicks off today. Alex Webb is with me now. Alex, I look at the market's reaction to the potential Apple-Alphabet relationship, and the alpha response is in the Alphabet stock price, not Apple. So if this is supposed to be seen as some kind of an AI salvation moment for Apple, it's not reflected in the price.
I mean, Apple is still trading up a bit, but of course it is giving a certain amount of ownership of the interaction to Google. And that will mean, potentially, if this deal is signed, that Google has the single most dominant position in mobile devices when it comes to that interface. You know, Apple's main competitor in mobile device operating systems is Android. That is, of course, developed and distributed by Google. So it gives Google a real lock on that, keyword. I won't say it because I don't want to set off all the people's phones out there. But if you say the keyword for Siri or for the Google Assistant, you're likely to be getting a Google AI interface or AI technology in response.
I mean, do you have any vision of how this might work? I mean, it'll certainly help, let's say, with day-to-day. There's Apple up 2.77%, Alphabet up 7%. Is this about the access to the 2 billion iPhones and where this AI and the ChatGPT functionality escalates and evolves to?
It's going to be, well, look, we don't have the full details. Let's caveat everything with that. The way that Apple has a relationship right now with Google in search is that Google pays Apple for the privilege of being the default search engine in the iPhone. I suspect that in this case of Gemini, it is far more likely to be that Apple pays Google for their technology. It is something that it is going to be this sort of medium through which you are able to interface with parts of the phone. I'm really interested to see how this works technologically. If you use ChatGPT, it is quite laggy. You know, you're not getting a response inside 5 seconds in many cases. Mm-hmm. There's a huge amount of compute power. Perhaps we'll get onto Nvidia, but that is driven largely by Nvidia. It has to go off to the cloud, be thought about in the cloud, and then delivered back to the phone. On the whole, Apple does it on device for the things they do in AI right now. And
in the great spirit of live TV, unfortunately, time has run against us, so we're going to have to wait for that Woodstock of AI. That is my favorite from Bank of America in terms of what today is there. Nvidia stock is up over 5% as we speak. Let's just check in on the price at the moment. Let's see what Jensen Huang has got to say to the market later on today in terms of chip and AI development. 4.28% now is where we are, up over 5% on the day. Abby is with me to round out the sectors for this Monday morning session. Abby.
Well, we are looking at a very strong session with the S&P 500 up about 0.8%. That's the best day since March 12th, so about a week or so. Apple, though, having its best day since mid-January, as you were mentioning, up more than 2%. Google up 7%, its best day since February of 2023. Not surprisingly, communication services then, which Google Alphabet is a part of, up 3.2%. Tech right behind it, up 1.7%. Utilities, financial and healthcare, the fact that those are in the bottom of the pile, that's actually risk on because those are some of the more defensive sectors. Let's take another look at that communication services surge. If we take a look at it in the context of over the last few days, well, there it is. Parabolic uptrend on the day, up 3.9%. Folks really want in on Alphabet on this possible AI deal with Apple.
What a beautiful word, parabolic. There we go. Straight up she goes. Abigail Doolittle on the sectors. Coming up on the show, market moving events to set your trading diary by. Some huge monetary policy decisions to be made this week globally, no more so than in the Fed. And if we are scaled back to 2 rate cuts in the dots, that's perhaps injurious to the wider economy. Look at this NASDAQ clawing back, powering ahead. Nvidia and Alphabet are the 2 single biggest drivers of this. If Alphabet gets on board with Apple to disseminate their technology, their AI technology through the iPhone, and Nvidia, will hear more about the chips that they are going to launch later today, the AI, the Woodstock AI equivalent. Some other notes for you. We've got NAHB Housing Market Index at the top of the hour. Also, that conference begins later on. We'll bring you the news flow from that. Tomorrow it is about the Bank of Japan and a slew of central bank decisions. Wednesday, it's the Fed's turn, plus Jay Powell's speech and news conference. And then the Bank of England on Thursday.